Welcome to the Bloomberg Markets Podcast. I'm Paul Sweeney, alongside my co-host, Matt Miller.
Every business day, we bring you interviews from CEOs, market pros, and Bloomberg experts, along with essential market-moving news.
Find the Bloomberg Markets Podcast on Apple Podcasts or wherever you listen to podcasts and at Bloomberg.com/podcast. All right, the big thing for me, I think, this week, there's a lot of ego data coming down, but are we going to have a strike in the auto industry? It kind of feels like it. And
huge. And that could push, by the way, not only the state of Michigan into a recession, but if it goes on for a long time, it could be bad for the growth trajectory of the U.S. economy and for the underlying inflation numbers.
It's big. So hopefully they can get something done. Joe Levington joins us here. He's a director credit research for Bloomberg Intelligence. In his day job, he covers kind of the industrial companies, including the auto companies. Joins us here in our Bloomberg Interactive Broker studio. So, Joe, what's your sense here? You know these companies for a long time. Does this feel like they're going to go on strike? The union will go on strike Thursday at midnight?
Yeah, no, definitely, Paul. It does feel like a strike is coming. Even when you see Bloomberg reporting that the UAW has offered some concessions, going from 40% growth to 36% growth is still a huge difference between the 14.5% that the auto companies seem to be giving.
So let's get the hard numbers behind that. This is what they want in terms of an increase for salary and benefits, right, Joel? So what does it boil down to in terms of the cost for the automakers to get an hour of work from a union member?
Yeah, no, you're totally right. The way that I've looked at it is really in terms of EBIT for 2024, in terms of profitability. In the best case scenario at 20%, you'd have something like Stellantis being about 2% impacted. So really not that much before you consider some of the things that they could do. For Ford, which has a bigger unionized auto group, it could be as much as 10% of 2024 EBIT. Now, I do think there are ways that they can offset it. And going to your point about inflation, price is the number one tool that they have to use is to increase prices and pass it on to consumers. Of course, that leads to different challenges and different
which
winners
they've
and
also
losers.
Done numerous times over the past couple of years.
That's exactly right.
When I priced my Dodge Challenger RT Scat Pack wide body,
Which has still not been delivered.
Which still has not been delivered. And I hear, by the way, from inside the company, they're like, yeah, you know what? I think it's going to be delivered September 15th. And now that's just 3 days away, and I've gotten bupkis in terms of... Anyway, the bottom line is when I ordered it in, a year ago, the price has already been increased like 2 or 3 times. And I'm wondering, do I have to then pay that price when they finally deliver it?
I don't know how that works.
No, in fact, you don't have to pay that price, but that's where some of the EV companies are getting hit materially, like a Rivian or a Lucid, which made deals 2 or 3 years ago, and now they're, offering these cars up at 30% less than what the price is today, and they're taking that loss and gross profit and really killing their liquidity. So, to your point, you won't have to get hit with that, Matt, but you did have to wait, and
I bet you the dealer's going to try. I'll bet the dealer tries.
But you're a savvy auto guy. You're not.
Well, now because Joel told me that,
Yeah. Well, I would say
I have documentation from the day I ordered.
I know the owner of Stellantis, the CEO of Stellantis. All right, so
that doesn't help. The dealer does not care.
It doesn't care. Okay.
I've interviewed Carlos Tavares. That doesn't help me when I go into the dealership.
All right, so Joel, if you're these big auto companies, you don't want to go on strike, but you feel like you can't pay a 30 or 40% increase in. So where do you think this shakes out?
Yeah, I think you probably get to a midpoint of maybe about 25% over 4 years. Now, the offsets to that is, if you increase pricing 1%, that takes a huge chunk of that increase away. And then you start thinking about costs and where you can do that. One of the things that I always think about is bringing in products that you have gotten from suppliers, so insourcing some componentry. If you do that, that means you might be saving money. That might be a pressure point for a lot of the auto suppliers and how they're going to get hit. Obviously, if you're going for pricing, that's a positive for the dealers and what that means for them.
Well, if they can move the metal, because consider that these increases are only going to hit GM, Ford, and Stellantis. So if you're cross-shopping, say, the newest GM electric vehicle and a Tesla, and Tesla has to pay its employees like a third of what GM pays their employees, you're going to find a better price over at Elon Musk's company.
I think you're totally right, Matt. I wrote about this a couple of weeks ago, how Tesla might actually be the biggest winner. Now, I'm sure folks in Tesla's plants see a, let's say, 25% increase, and they're going to be asking for something too. But my guess is it's incremental or modest relative to what the UAW is going to get. So on a relative basis, Tesla is going to win on that. And as you've seen, what they've done this year is they've used that price to cut their prices or take a relative price cut and draw demand off of it, which I think means that Tesla will be, like the eventual winner out of this game with the auto companies.
And the others who produce here that don't have union labor, right? Which is like a ton of Asian and European automakers.
So like the BMW plants in Tennessee or wherever they put them.
South Carolina.
Are they not unionized?
They're not. And so, there is going to be a relative trait here in terms of how much you can go. And it's one of the reasons why the auto companies are pushing back so hard, because they play in a global market space.
I don't know. So, all right,
you got to decide as a worker, Paul. Do you want to live in Spartanburg? Do you want to live in Austin? Do you want to live in Motown?
Probably Spartanburg's looking pretty good to me. All right, so from the balance sheet perspective, Joel, do any of these Ford, GM, Stellantis, do they have a balance sheet that you're nervous about should a long strike take place?
Well, the thing that I look at the most, and this is really a Ford and GM issue more than a Stellantis issue, is that the way that they get paid is that they get paid when they sell the car to the dealer, right? But they don't pay their suppliers until your typical 45 or 60 days afterwards. What that means is that they have a huge amount of payables that are lined up and very little receivables. When you have a stoppage of work, there's no receivable money coming in, but there's a huge amount of payables to the tune of maybe like $5 billion a quarter. So you have to have massive amounts of liquidity to handle kind of such a situation, which is really what Ford and GM have. I think Ford has something like $50 billion of liquidity available. GM has about $45 billion of liquidity available. So they can handle near-term impact, but it has a huge view in terms of free cash flow for a year, in terms of the liquidity on their balance sheet.
They got a lot of leverage here. I'm looking at GM. I mean, they got a debt to EBITDA. I mean, there's a lot there.
There is, but keep in mind that includes the finance company. When you strip that out, if the leverage at GM and Ford is actually relatively modest, maybe more like 1 to 1.5 turns.
Okay.
It's really that they have finance companies, which is kind of hard to see sometimes, just because it's blended all together under their primary.
Now, I will say, everyone we talked to we talked to Seth Harris yesterday at Northeastern, who used to be an advisor to President Biden and Deputy Director of the White House's National Economic Council, and Claudia Sahm, she of the Sahm rule. They all say, look, the union took bad deals for the workers at the end of the financial crisis, and the car makers have raked it in since then. Surely they've been setting aside billions because they knew these negotiations were coming, right?
Surely.
But you're right. I mean, they got a certain deal with certain pay increases, and then this inflation came along, which nobody saw. And then, boom, now they feel like they need to get it back. It's going to be interesting. It feels contentious. Hopefully they can get something done by midnight Thursday night.
Especially if they haven't produced my Challenger.
I know.
Yeah,
I mean,
because I need them to make that and send it here.
That should be the priority of the negotiation.
The whole thing. We got to get that thing off the line. Joel Levington, he's Director of Credit Research for Bloomberg Intelligence, Senior Auto and Industrial Credit Analyst as well. So we appreciate getting some of his thoughts here. Again, big issues for the auto manufacturers coming up. Big labor, big auto. We've got strikes seemingly in a number of industries across this country.
You're listening to The Tape. Catch our live program, Bloomberg Markets, weekdays at 10 a.m. Eastern on Bloomberg.com, the iHeartRadio app, and the Bloomberg Business app, or listen on demand wherever you get your podcasts.
Monica Tefend joins us. She's a head and chief strategist at Amundi Institute. That's Europe's largest asset manager. She joins us here in the Bloomberg Interactive Broker Studio. Love to have her in studio here. So, Monica, talk to us about kind of the European economy. I know we can't talk about it as in a whole because you have so many different countries, but my concern, I think my understanding is, if Germany's in trouble, Europe's in trouble. Talk to us about how you guys view the European economies.
Well, short term, we are really relying on Americans taking over during the summer. So probably we can have some lift on the quarterly GDP sequencing. But as you were rightly pointing out, on an aggregate, Euroland is not doing bad. If you look at the Commission, at the EU Commission projection released yesterday, there is no recession, but flattish growth. It is true that if you open the box, there are different countries within the same region, with Germany that is running into a recession for different reasons. It started with the manufacturing sector paying the toll of the industrial policy and of an economy centered on energy dependence, but now is moving into the service sector. Industrial production data were soft last week, but it goes without saying that if Germany is in trouble, this is going to be difficult for the entire region. Having said that, we have some other countries, France, for example, where we see the political willingness to continue to run fiscal support for the country, and France is an important economy. Spain, again, has been supported by subsidies on the energy sector, and this has been supporting consumption. It is going to fade away. And last but not least, Italy, where, again, the construction boom is over. So it is true that on aggregate, the situation is manageable. Probably at country level, there are several issues that needs to be tackled.
But not a super attractive place to invest, right? I mean, Germany's manufacturing sector is going to be hit hard by problems in China, failures there, and threats from companies like Tesla, who seem to be able to do Volkswagen's work far better. The French have luxury goods that, again, won't be purchased by rich Chinese people anytime soon. The Italians have democratic disaster, like constant for the last, 50, 60, 70 years. And the Spanish are just supported by the rest of the continent. Plus, Britain shoots itself in the foot any chance it gets. I mean, where would you invest if you wanted to go to Europe?
Well, nice to see this from the American perspective. It's not that bad if you are a European. But having said that, first of all, in engaging the green transition at bottom-up level, there are some nice evidence. It is true that China slowdown is not is negative for the region, but we need to resize, starting from Germany, the dependence to China when it goes to trade and exportation, because a lot is done within the region, starting from Germany, which is an important take. If you ask me, long term, probably as Europeans, we should think more on an industrial on our industrial policy, but this is what we are discussing when it goes to healthcare, when it goes to pharma. It's going beyond the semiconductor story, and I think we are moving slowly, but we are active on that front.
So at Amundi, where are you guys in terms of your asset allocation these days, and maybe how it's changed over the last several years?
Well, it has been, given the macro uncertainty and the uncertainty on the monetary policy framework, it has been difficult really to pencil a medium to long-term strategy. We have been quite agile, for example, on the duration positioning, with a preference for a US long and a EU neutral position. But again, it has been the time for agile, tactical, relative positioning. When it goes to the risk asset, we've been progressively reducing the exposure to credit, notably the high yield.
So reducing exposure to high yield credit. Does that suggest you guys are just generally more conservative on your economic outlook and interest rate policies?
It was also going into the U.S. high yield, I have to say. So it's really when you need to balance the risk return opportunity, probably repositioning on govies and equity on the traditional was for us more appealing. Equity-wise, while maintaining a cautious stance, we do like the U.S. value. And on the emerging market, we have been repositioning, moving to neutral into Chinese equity, but being more active in the emerging market region, notably Brazil, India, for example, Indonesia. So
India.
these are all countries that for different reasons are getting track.
But you are looking into U.S. value. Are you concerned that we do eventually have a recession here? The consumer's looking pretty stretched. We're going to get some data, I know, out on Thursday, retail spending, and it looks much worse than the last month's data we got. We're going to get inflation data out tomorrow that looks worse than last month's data that we got. Is the situation here getting worse?
So when it goes to the recession call, we do believe there will be a shallow recession. This will materialize likely in the first half of 2024 for the reason you were mentioning. The labor market is eventually cooling. Excess savings have been reducing remarkably over time, and probably also the fiscal, the Bidenomics and impulse to the investments, business investments won't be there for longer. When it goes to CPI and inflation, we think it is normalizing. It will normalize it, probably not in a linear way. Energy prices, recent prints on oil will have a positive contribution to headline, and the core will prove to be sticky. But as I was saying, overall, we expect this non-linear and volatile and probably less rapid than expected downward trend on inflation to continue. And this ends with the call that we are making on the Fed, where we expect them to hawkish pause.
Hawkish pause. I'm down with that. All right. So you spend half your time in Paris, half your time in Milan area. How was Lake Como this summer? I have yet to go to Lake Como, but it's on my bucket list.
Wait, you mean you've yet to go to Lake Como ever?
Ever. And I've been to Milan like a dozen times.
What? Why would you spend so much time in boring Milan and
make
not
money.
Get up to Lake Como where
that's
things
where
are
the money
exciting?
is. That's where the money managers are. All right.
I guess so.
So I was in Chernobyl early in September, where we are having this think tank meeting, and the people out there were saying we have been taken over by Americans, and we do thank George Clooney.
I was going to say, as long as it's George Clooney, you must be happy to have us, you know?
Honestly, being an Italian, I don't know why you guys are going to the Lake of Como and not to the seaside in Sardinia or in Sicilia. Probably is the weather. Yep. But definitely there are a lot of tourists. We are really seeing this renaissance in Milan itself.
Nice. I love Milan. It's great.
I have to say,
but they're
all
taking
of
down
Italy.
San Siro.
I've spent time in Sicily.
I know.
I've been in Bari. I've been in
Rome.
Venice a number of times. I've been in Florence,
I
Rome.
gotta get
I've done
more.
cycling trips around the country. I've done cooking trips in the country. I've been to the horse race.
I had to
paleo.
work. I had to work for a living. Monica Defend, thanks for joining us. She's head and chief strategist at Amundi Institute.
You're listening to The Tape. Catch our live program, Bloomberg Markets, weekdays at 10 a.m. Eastern on Bloomberg Radio, the TuneIn app, Bloomberg.com, and the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
All right, we had an M&A trade in the packaging industry. Smurfit Kappa Group, it's Irish, doesn't sound it, but it's Irish, agreed to acquire WestRock, an $11.2 billion deal that creates a packaging industry powerhouse domiciled in my homeland of Ireland. Pretty cool stuff. And we actually have an analyst who knows this business, believe it or not. Richard Bourke joins us. He's a senior analyst at Bloomberg Intelligence, covering all the basic materials. I want to talk to you about this deal. I want to talk to you about the potential auto strike, what that means for steel. Lots of stuff to talk to you about today. Richard, what's going on here with this deal? It's a big deal. I guess we need more heft in the packaging industry.
Well, what it is if you look at the two players, WestRock is undergoing what they call a strategic transformation. They're trying to boost their margins versus their peers. Their margins trail their peers. They undertook a transformation program, and it may be going a little bit slower than they want to. Smurfit Kappa doesn't have a presence in the U.S. This gives them a large presence in the U.S. Smurfit Kappa's margins are about 300 basis points higher than WestRock's. And they undertook their journey about 7 years ago. They started a capital improvement program, and now they're at the end of it. And, from what the executives laid out on this morning's call was, we think we can help WestRock on their journey and combine the companies going forward and boost WestRock's margins, bring them more in line to what Smurfit Kappa is.
So one of these companies I never heard of before, WestRock. The other one, I never knew what they did, Smurfit Kappa. Now they're going to have a combined annual revenue of $34 billion. What do they make?
They make basically pretty much predominantly just cardboard boxes.
See? Told you, it's a cardboard box company.
I mean, yeah, but like so, iPhone boxes,
The gamut. The
Tiffany
gamut,
boxes.
The gamut from,
just regular U-Haul boxes, like
U-Haul, the gamut. They go all the way across the universe to the cardboard box that Amazon puts on your, probably the 3 cardboard boxes that Amazon puts on your doorsteps, the big one to protect everything, and then the smaller ones in it. And they also make all the way down to those very more brand, where retailers are trying to get more brand experience. The other big thing that's driving this is, especially more so in Europe, is the way away from plastic packaging. So, for example, one of the big products that WestRock's just really introduced was a thing to do away. Remember when you used to buy a 6-pack of beer and it had the plastic rings? They have a product that does away with the plastic rings.
I use that, and that is a great product because it's so much easier to get the cans out of there. So that was brilliant.
You mean the black plastic caps that go on top of like?
No, but you buy a 6-pack of soda, instead of having the little plastic rings holding it, this is like a little cardboard top that just kind of holds them all together, and it's just very easy to take the can out of the little cardboard top or take the whole cardboard top off. Genius, whoever thought of that.
And less likely to strangle fish or
exactly
whatever. Yeah.
Right. Which I've been cutting those up since I was a little kid. You know, the little things.
Good for you,
So
Paul.
I tell you, I do my part.
Who cares?
The packing business. I mean, talk to us just about the corrugated box business. There's pre-pandemic, there's huge demand, but then the pandemic hit. Then everybody that got stuff delivered. Talk to us about the last 3, 4, 5 years in that business.
Well, we've gone from pre-pandemic, where historically the packaging business kind of GDP type growth.
GDP growth, okay.
Pandemic hits, everybody's at home, nobody can spend money on restaurants or food or travel. Well, you got to spend money somehow, so you ordered goods over the internet.
Yep.
Everything came to these boxes. So the box, over a 2-year period, went from GDP type growth to about 8-9% growth. Then what happened, it totally reversed, because everybody, after the pandemic was over, everybody had what they call revenge travel and everything. And we've been in a downfall. In fact, we're actually back to almost pre-pandemic levels.
Okay.
So there's been, but the bigger push longer term is, again, back to sustainability. Can we replace plastic packaging with cardboard?
You know what? Way back in the day, I had an investment in a box company, like just this southeastern U.S. Never made a dime on it, and then and I sold back my stake. Then this company named Amazon came out. I was like, oh, I missed it.
And bought them or what?
No, just kind of came out and said, we're going to start shipping everything to you. And, of course, then this company's value went through the roof. All right, we got a potential strike coming out of the auto business. If they're not making cars, does that mean they don't need steel, in which case we're going to have some issues with steel? Talk to us about how that might impact steel.
Correct. If you look at the auto market for the steel sector, auto demand, or the auto end market, is about 25% of the steel market.
Okay.
So if we see that, and not only do you kind of have a ripple effect. Not only do the big car makers stop making cars, but everybody who makes parts, the tier 1, the tier 2, the tier 3 suppliers stop making the parts too. And in the difference between this strike possibly and the last strike is, normally the UAW, you would only target one automaker. This time they're talking about maybe targeting all 3. So we'll see if the rhetoric has definitely ramped up, and we'll see what happens.
What are the steelmakers themselves saying? Are they just kind of staying out of it, and we'll say,
they've been quiet. The thing that was interesting, I thought, second quarter on their earnings call, a few of them mentioned that they had anecdotally shipped more in the second quarter than they were expecting to the automakers, which exactly tells me the automakers were like, okay, maybe we need to ramp up production and things like that. And honestly, you're not going to see, if they do strike their schedule, the contract expires this Thursday night at 11:59 p.m. We're already halfway through, halfway through the month, but you're only 2 weeks from the end of the quarter, so you may not see that big of an effect on this quarter on the steel makers. It will probably be more of a next quarter things. Also, the steel makers normally take some downtime, and they kind of rejiggered their downtime to kind of be
I see.
going forward, so if there is a hit, that they're not as impacted as they might have been.
Interesting. I mean, do the auto guys, are they like a just in time with their steel? It's like I placed my steel order because I'm going to start bending it like tomorrow or next week or something.
Most of it all depends on where you're at. Like the big three are definitely probably more just in time.
Okay.
Where some of the suppliers, tier 1, tier 2, tier 3 aren't as, everybody's trying to be just in time, but they probably do hold more inventory than the big three.
All right, so boom, we knocked out corrugated boxes and steel in one segment. How good is that? You can do that with Rich Bourke. Why? He gets a bachelor's degree in engineering from Illinois. Then he goes and gets a master's in engineering, electrical engineering, and then he goes and gets an MBA from Chicago. You can't get the guy out of Illinois. All right, good stuff, Rich. We appreciate it from Bloomberg Intelligence.
You're listening to The Tape. Catch our live program, Bloomberg Markets, weekdays at 10 a.m. Eastern on Bloomberg.com, the iHeartRadio app, and the Bloomberg Business app, or listen on demand wherever you get your podcasts.
Let's talk about shipping boxes. We had an M&A trade in the corrugated box business. Who would have thunk it?
Smurfit Kappa buying.
Yep. 11 billion, so 11 large there. So kind of staying on the box thing and kind of moving boxes around. We have Mike Parra. Mike joins us. He is the CEO for the Americas for DHL Express. He joins us live here in our Bloomberg Interactive Broker studio. So Mike, I don't know, do you care where the boxes come from? It's your job just to move them, right?
Absolutely. Yeah, but I would say we would like to see less air inside those boxes. So that was a great interview, and I am in
so
complete
less
support.
air in the boxes.
Less air in the boxes.
What does that mean?
Well, I mean, remember, air takes up space,
right?
And then also, when you got more air in boxes, you have a greater propensity to have damage.
Okay.
As well. So less air, less damage. Less air means we can put more boxes into our aircraft.
All right, what percent of your aircraft? I guess what percentage full do they fly when they actually take off?
Well, you're going to fly. You're going to fly. It's not going to be at full weight because that would be ideal. By the way, that means you're moving water,
right?
As an example. But on average, our weight load factor is somewhere between 80 and 90% is where we're at from a weight load factor on an aircraft.
So, how does it look to you right now? Because you have a great position in terms of judging. The U.S. economy, right? Are we still buying and shipping just as much stuff as we were last quarter or the same quarter last year?
Yeah, one of the great things that we're seeing as a result of what's going on globally in this move away from China, we're never going to decouple ourselves from China, but we are seeing, friendshoring, nearshoring, omnishoring that's taking place, and we're seeing a lot more outbound from the U.S., which is encouraging. It's encouraging for us, but we're seeing it predominantly in the space of e-commerce.
Okay.
So that's what we're seeing, which is fantastic. But what we have seen is we're starting to see that China plus one really starting to happen. As an example, near and dear to me, because it's within my region, is Mexico. And you're starting to hear this term made in Mexico. Yep. We're starting to see that in the northern part of Mexico. So, Guadalajara, Ciudad Juarez, those markets, we're starting to see an explosion. Raw goods coming in, being assembled, and then exported out of Mexico, either back to the U.S., to Canada, or throughout the rest of the world.
Where does DHL Americas fly to? Where do your planes go?
Across the entire Americas.
Okay.
So we fly intra-Americas and then out of the Americas to Europe, Asia, the Middle East, and Africa.
Are there certain airports that are hubs for you guys?
Absolutely. Yeah, our big air hub for the Americas is in northern Kentucky in Cincinnati.
Gotcha.
We're doing 90 departures in and 90 arrivals in on a daily basis.
How do you compete with, when you talk shipping in this country, everybody knows. I just moved here, by the way, from Germany. So
no problem.
For me, DHL was on my doorstep every single day. But now,
thank you.
It's UPS, FedEx, Amazon. How do you compete with those big guys?
Yeah, we're not competing in the space of intra-U.S. So we got out of the U.S. book of business back in 2007, going into 2008, because we wanted to focus on our core competency. And our core competency is international. So the world into the U.S., the U.S. to the world. So that's our focus. That's the lane that we play in, and we have been extremely successful.
Is it getting harder or easier in terms? I actually have a lot of experience with those kinds of shipping as well. I'm constantly trying to get a set of triple trees from Italy to here, or shipping Olin's forks back to Sweden for something. So it's difficult to deal with customs, all the different regulations. Sure. Is that getting easier or is that getting harder?
In reality, it's been the same. What is getting easier is through automation and digitalization. We clear 92% of our shipments are cleared in the air. So they're cleared by customs in the air. And then they're only really looking at somewhere in the range of 7 to 8% is what they're looking at. They're targeting those specifically. Now, you get that through having a great relationship and a consistent relationship that spans over a long period of time with customs, where the reliability of the information, the contents that we're moving, line up with the manifest that we're submitting to them electronically. So that part is getting easier. Where it gets difficult is when you have someone who refuses to give you the right level of information. An EIN number, the HTS code for clearance is wrong. Those type of things is where shipment gets delayed. But 90 to 92% of our goods are cleared in the air. So that makes it easier. Whereas before, if you would have gone I started 37 years ago in this industry, it was much harder. It was much more of a manual process, much more of an open a shipment, look and see. Today, it's much easier from that perspective.
All right, so you ship from the Americas out to the rest of the world and back.
Yes.
Where are the growth areas versus maybe the not so growthy areas?
Well, we're seeing growth out of Canada.
Okay.
So in what we're calling friendshoring, Canada, the U.S., and Mexico, we're seeing a lot of growth. From that perspective, we're seeing growth in parts of Central and South America. As a matter of fact, we just launched our own dedicated flight now to Argentina. So we're starting to see growth, and it goes Miami, Argentina, Chile, back to Central America, and then back up to the States. So we're seeing growth in those markets as well. Every time we have a growth market, we'll come off a commercial airline and we'll put our own aircraft in place.
So what does that mean? You'll take some of your packages
off commercial airline where we were buying belly space before, and then we'll put it on.
Talk to me about that business, which I never really understand. So what percentage of your business goes on an airline, and what goes on your plane, and how do you make that decision?
So thank you for asking that question, by the way. We're the largest commercial airline purchaser of belly space in the world.
Okay.
Through all of our entities from a DHL Group perspective. The decision is made once you have greater than 50% weight load factor that you can put on your own plane, where you can start to pay for the physical asset up and down and the fuel that you have going into that plane. So the cost of operating an aircraft.
And fuel costs, I mean, right now, the outlook isn't great with, we're reporting that there's going to be a 3 million barrel a day shortfall in the next quarter because of the output cuts from OPEC+.
Yeah, fuel costs is interesting up and down, right? So fuel is always somewhere between 70 and 100, and we almost think that there's a reason for that. The interesting part about that is we have what's called the fuel surcharge, and that's where we take those expenses and we pass on the least amount that we have to our customers associated with it. But that's how we protect ourselves. And it either goes up or it comes down. We protect the customer on the way down.
The other big cost is labor. How's that looking?
Yeah, okay. We're fine.
Because it was tough, right, for a couple years?
It was tough for a while. The good thing about now is we're replacing roles. We're hiring roles where we need to, which is a good thing. And we're getting ready for peak season, which is, by the way, in our opinion, is going to be a soft peak season. The uncertainty remains. It is going to be a soft peak season. It's going to be in line with what we saw last year. But really, the next couple of weeks are going to be very telling. The end of this month, the beginning of October are going to be very telling to see what's going to happen in peak season. Because really what starts to happen is people start to order in advance of Black Friday, Cyber Monday, and the lead up to the Christmas holidays. So we're keeping a close eye as to what's going to happen here over the next couple of weeks.
20 seconds. What kind of aircraft do you fly? And can you get them?
So we're flying 777s.
Nice.
We're flying 767s, 737s. And then we still have a couple 747s that are out there, 800s. Can we get them? Yeah, there's aircraft today that are available, much more aircraft today available based on the shortfall in volume that was out there and people standing down planes and right-sizing their network. We right-sized our network 18 months ago. We're constantly right-sizing our network, so it's not a new initiative for us at DHL.
Fascinating. I could talk about this stuff all day.
Yep.
Mike Parra, thanks so much for joining us. He's the CEO of the Americas for DHL Express, kind of getting a good view on kind of the economy and where we're seeing some growth and not so much growth.
You're listening to The Tape. Catch our live program, Bloomberg Markets, weekdays at 10 a.m. Eastern on Bloomberg Radio, the TuneIn app, Bloomberg.com, and the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
What we also like is commercial real estate, because I have no idea how this business is going to shake out. So we're glad that we have an informed guest joining us, Barry DiRaimondo, founder and CEO of Steelwave. He joins us live here in our Bloomberg Interactive Brokers studio. Barry, thanks so much for joining us here. What Steelwave, what kind of real estate do you guys play in, and where? We'll start there.
Well, we're West Coast based.
Okay.
Right, and the triangle is really San Diego south, up to Seattle to the north, out to Austin. It's all the tech hubs.
Okay.
And it's office, it's life science, and it's industrial.
All right. So office.
Well, you can't paint it with a broad brush, right? When you say office, you're talking about Third Avenue here. In New York.
We talked about Third
Right?
Avenue.
Yeah.
So now I understand that he's like in the real world.
Yes.
Austin, San Diego, stuff like that. How is office space in the real world outside of New York City?
Well, it's got its challenges, sure. I mean, look, you've got the capital markets issues with high interest rates and cap rates and all the stuff that brings. But you've got that with multifamily or industrial. What you don't have in multifamily and industrial is the supply-demand headwinds that you have in office. And you're still dealing with work from home. So you've got all that stuff going on the office sector that, is candidly created an enormous dislocation, in that market.
So is office space, I mean, when you say life sciences and tech, I'm thinking about chip fabs and laboratories, but you're talking about actual office where the same thing could be done from home.
Yes. Yeah, I mean, look, on some level, you're competing with someone's couch.
Yeah.
All right, for office space. And in order to bring people back into the office, you got to create environments that people want to come to work in. And this isn't, post-COVID. This has been happening we started seeing the trends really in the early 2000s, and it's just magnified over time. But you got to create a work environment that's highly amenitized, where people actually want to come to work, and it doesn't feel like you're at work when you're at work.
So have you done that with your properties, and what have you done? How have you done, and has it worked?
Yeah, I mean that's kind of our design theme. We're very much of a design-driven group, and it's adding hospitality, it's adding residential elements to it, so it doesn't feel like an office building, candidly. We tend to cater to the innovation workforce. It's all tech, media tech, traditional tech, biotech, go down the list. So we're trying to attract the innovation workforce back to the office, and you have to create amenities such that people don't think they're in the office
So
anymore.
when you say amenities, I mean, we think about Google ping pong table and snacks, right? But you're talking, I would guess, more about fitness, gyms, maybe restaurants, daycares.
All of that,
Yeah.
right? Cool. And it's not just the run-of-the-mill stuff. It's creating kind of differentiated, food and beverage, options, full health centers, for people to take advantage of. What you're trying to do is bring people together. That's really what you're doing. So if you just create a gym and stick it off in the corner, that's not collaborative. What you got to do is amenitize the gym, and you got yoga classes, you got where people actually get together.
Do you have any evidence that if you do that, if you make that investment, which impacts your returns, if you do make that investment, does it work?
Unequivocally. Look, we're at a point in the market where if you don't make that investment, there's no rent that'll clear for a commodity
I hate
office
when I
building.
hear something like that.
I like it because I want to work in your office.
Yeah.
When I
But
hear
look at
about
our
that,
office. We got fish, we got food, we got flowers, look at this office.
well,
Oh,
we
I
have
get it.
we have a pretty great office.
We got the best, I think. But
gym,
out there,
of
but I
course.
just think about driving out there in real America, which I do occasionally get off this island, and there's so many office buildings, and every single one has announcing how much space they have available there. And
All you got to do is look at the parking lot.
Yeah, that's right.
That's your biggest indicator. If there's no cars, guess what? There's no bodies.
So how do you guys in that office how do you think about your business? Have you taken your return parameters down dramatically? Because at the time you've got your properties, I'm guessing, have higher occupancies than pre-pandemic, and your cost of capital is higher.
I think that's right. I mean, the cost of capital is, at the moment, you got to understand, today is a dislocated market. So it's kind of upside down. So you can't look at what's happening at this very moment as a barometer to, the market in general. I would say a commodity office building, whether it's New York or San Francisco, today, if it had to trade, compared to, say, 18, 24 months ago, is trading at 40 to 30% of what it would have traded for. Not 40 to 30% off, talking 60 to 70% off.
Oh man, and I don't know how.
But that's a commodity office building. But what you do is different, and also the rents that you get are higher, I imagine, because if you create the kind of space that you're talking about, people will be bidding on that space and willing to and trying to outbid competitors, right?
Well, more importantly, there's a rent that'll clear. And if you're a commodity, there is no rent that'll clear. I mean, there's people think, well, I just lower the rents and my occupancy is going to go up. That actually doesn't work in office, for a commodity office. If it's apartments, you lower your rents, your occupancy goes up. For office, depending on what kind of office you have, there may not be a rent that clears. And, it's a very bifurcated market. Excuse me. I mean, if you look at Hudson Yards, they're pushing rents up.
Yeah.
Right? But if you look at sort of mid-block, 3rd Avenue here, I'm not sure there's a rent that'll clear.
Wow. See, that's kind of where I think the market is, and that is brutal. Did they start knocking down office buildings around the country?
I would want to work in Hudson Yards.
Yeah.
And I would not want to work on 3rd Avenue.
See, there, I know. I guess before I would tell you, I don't care what you want. But now I have to care, right? I have to care. Again, Barry, you're another guy we could talk to all day long on this stuff.
Yeah.
Barry DiRaimondo, founder and CEO of Steelwave, based on the West Coast. Whenever you're back in New York, let us know.
You're listening to The Tape. Catch our live program, Bloomberg Markets, weekdays at 10 a.m. Eastern on Bloomberg Radio, the TuneIn app, Bloomberg.com, and the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
I'm going to put this on the bucket list. I have to go on a cruise.
Yeah, you do.
You have to. You just have to try it.
For one thing, you got to be curious.
I'm curious. I'm curious. So I'll put that on the bucket list. But you know how I love the cruise business. I think it's a fascinating business model. And we've got a great person to talk to about that. That's Tors Hagen, CEO and chairman of Viking Cruises. Tors, thanks so much for joining us here. I got a million questions here, but I'd love to just get a real 30,000-foot view from you about how is the cruise business today versus pre-pandemic? It was just no industry in my mind, or you're one of the industries that really got impacted the most immediate and most directly. How has your industry changed?
Well, I can't speak so much about the industry, but I can speak well about ourselves. And you can say we are now back to a higher level of demand than we had before the pandemic. It's I've never seen anything like this in my life. So our ships this year have been full, and we are heading into 2024 with, I think, 70% of our capacity sold on our ocean business and 60% on our river business. So it's rebounded very nicely. Now, in your introduction, you meant that you're curious.
Yes.
And I think that's one of the reasons we're doing so well, because our guests are curious travelers. They don't go on a cruise to sit by the pool and get suntanned and so forth. They go places to experience and to relive history and so forth. And of course, Europe is a very big destination for us. So we hit it quite well. And we are kind of contrarian. So during the pandemic, we took delivery of, I think it was 16 new ships. And people said, you must be nuts. What are you going to do when this is over? And this year, we are filling it entirely.
So Viking Cruises is very different from the, Royal Caribbean kind of Disney.
Yep.
It's not, as you say, Tors, about, drinking a pina colada by the pool, and it doesn't matter where you are.
I don't object to drinking pina colada, but that's not why our guests go on cruises.
No, I just look at the destinations, and it's more about exploration for Viking Cruises, more about adventure.
Yeah, you can say it's exploration in the widest sense, because exploration is seeing places. But it's also, I call it the mental exploration, because our guests are mature travelers. They've seen most things in life, but now here's a chance of sort of reliving things they'd only read about before. So it's a great thing to do.
And when I noticed that
we are different, we are so different from the others that a couple of years ago we even dropped cruises from our name. So we are now just plain Viking.
So
to sort of,
what I understand about your business that is different from some of the others is you're not just ocean. You have a river cruise line and expedition.
Well, and I would imagine that's where
Mississippi.
the focus is, right?
Yeah.
Because
the two are about of equal size. We started as a river company in Russia of all places, but we are now about 50-50 river and ocean, and the expedition business is very, very nice too. I took my first vacation 25 years over Christmas, and I went to Antarctica. And somebody asked me, where would you like to go next? I really like to go back. It was a phenomenal experience.
Talk to me about the labor, because so many industries have suggested that labor is one of the real challenges they face. Is that also the case with your company? And if so, how do you deal with it?
If I say no, that's a little bit strong, maybe. But the point is that during pandemic, we took care of our staff. We didn't do like the others and sent them all home. We took care of our staff greatly. So we didn't have any problem starting up. Other travel companies have had big issues getting restarted, and we didn't have that, quite frankly. So I think we're quite different. We are, I can call it, family-controlled company, but we have two financial shareholders too. But you can say we are not a conglomerate. We are not part of a conglomerate, and we can generally say that customers do come first. And when I say customers come first, maybe you should even say our staff come first. So we have very good ratings by our guests. They love our staff. Ships is one thing, but the way we deal with the staff and the way our staff deals with our guests is second to none. So we are very different.
I wonder a little bit about you and how this company started. You briefly alluded to the fact that I guess your first cruise was a river cruise in St. Petersburg, Russia, or at least the business started there, and now your headquarters, I believe, are in Basel, but you're clearly Norwegian. So how does this all work out? How did it all work out?
Yeah, well, I've had a long life in the cruise industry, and I've done a lot of things in my life. But my heart had always been with cruises. I ran a company called Royal Viking Line once upon a time, and I thought it'd be nice if we could recreate something like it. It was the cruise line of the times in the 80s, but somebody went ahead, bought it, and destroyed it. So I said, maybe I could have a chance of recreating it. But I've had a life, full of ups and downs, and that's called life in my vocabulary. And we're very pleased with where we are now, of course. It's been a phenomenal success. And we're doing it because there are some things that make us stand out. We have one brand, not part of a conglomerate. We have no children on board, no casinos, no nickel and diming, and then there's only one language on board our ships. So it's not this mixture of everything. We are very clear as to what we do.
So what are some of the popular destinations right now, tours?
I say Europe remains popular, and we have more than half our cruises involve Europe, and you can see even Europe in the winter is quite okay. Now we have you can go to Norway and see the Northern Lights. The weather can be a little bit rough, but to see the Northern Lights from a ship in Norway is fantastic. Of course, the other thing we have is we have started an operation in Egypt. We were there now in a couple of months ago to take delivery of new ships. We have by far the greatest ships on the Nile River. I think we have 4 now, and we have another 4 coming. So the Nile is extremely popular. As a matter of fact, it's virtually sold out for next year, 2024, and it's pretty much sold out for 2025 even. So we have now had to open 2026.
It's an amazing.
It's nice
I've done a cruise up and down the Nile. It's the only place I've ever gone on a cruise.
Yeah, I was there. It was 42 degrees centigrade. I don't know, what's that, 104 Fahrenheit or something.
It's too hot.
It sounds terrible, but the heat is dry, and to be on the Nile and have the wind, the breeze in your face, it's. So we decided, well, hey, we can do this in August.
How has the Russian invasion of Ukraine at all impacted your business?
Yeah, we have, as I said, we started our business in Russia, so we still have 5 ships there. They're doing nothing. Of course, we have to take care of our staff so that when this will reopen, whenever that will be, they'll be ready to go. Of course, they need to feed their families too. So it's to have 5 ships doing nothing is not fun. It's not such a large part of our business anymore. And we have 1 ship in Ukraine. It has been in Odessa. It still is there, at least the last things I saw on television. But who knows? It's a terrible situation for everybody involved.
What about the China situation? Have you got? I know you have Chinese flags over some of your ships. Are they cruising?
Yes, we started in 2019, or a couple of years before that. In 2019, we had 4 river ships in Europe with Chinese staff, Chinese food, and Chinese signage, and the guests are all one language. That's sort of the mantra we have. When we do something, it's important that people travel with like-minded people. Then we have had one of our ocean ships that has become part of a joint venture with China merchants. That is now operating between Shanghai and Japan, and will be going between Shenzhen and Vietnam. But you can say the startup after COVID in China has been a bit slow.
Right.
But of course, when you look at the potential for the Chinese market, it's huge. We have had consulting firms assess what does huge mean, and when we look at it, it's huge.
I can understand.
So it's just a matter of being prepared to take some losses for a couple of years,
right,
and then we'll be off to the races.
All right, Tors, we're going to have to leave it there, but thank you so much. We really appreciate getting your time. Fascinating discussion. Tors Hagen, CEO and chairman of Viking. It's not Viking Cruises, it's Viking, so we're going to go with that. That makes a lot of sense. Fascinating discussion. We appreciate getting some of Tors' time.
Thanks for listening to the Bloomberg Markets Podcast. You can subscribe and listen to interviews at Apple Podcasts or whatever podcast platform you prefer. I'm Matt Miller. I'm on Twitter at MattMiller1973.
And I'm Paul Sweeney. I'm on Twitter at PT Sweeney. Before the podcast, you can always catch us worldwide at Bloomberg Radio.